everybody. This is Toni Turner, and welcome to the market now as of Friday, August 20th, right at the market's close. Well, Wall Street capped a tumultuous week with a broad-based rally today as investors largely shrugged off the looming threat of the COVID-19 Delta variant and signals from the U.S. Federal Reserve that it could begin tightening its dovish monetary policy sooner than expected. Tech stocks once again did the heavy lifting today, and growth stocks in general were given a boost by U.S. Treasury yields. And on that note, let's go on to three charts that could give us some insight into the week to come. Today, as we always do, we're going to look at the daily chart of the S&P 500 SPDR, SPY. As you all know, we track this or keep an eye on this chart so we can see exactly where the benchmark index, the S&P 500, see where it is and what its mood and manner is. Now today at the close, Friday close, the SPY, as you can see here, closed at $443 right down here and 54 cents. Now it did make a new all-time closing high on August 16th at $446.97. Then after it did that, that was actually the Monday of this past week. Then it started down. It went below the 20-day moving average for the first time in quite a while, down almost to the 50-day moving average, down to a low yesterday or August 19th at $436.12. Notice how it neatly stayed above the green line, the 50-day moving average, which is trading at $434.13 today. So it managed to stay above that line, and that is a good thing. And it closed a bit higher yesterday. So today, as we see, it popped back up above the red line, the 20-day moving average. Quite a bit of volume in the last few days, as one can imagine there would be. And so right now we're still safe here again at 443.54, closing the week out. Not at the highs, but certainly better than earlier. So our new resistance now is going to stay and remain here at 447. We have support down here, potential support we always call it, at the 50-day moving average right at 434. And then we have more support down here, potential support at that pivot low at about 422. We can move on down here to about 415. We can always look down here at the 200-day moving average. That's pretty far away. Hopefully we don't see that in a while, and that's down at $400.65 right now. So as you all know, in the coming week, we're going to have to see if the SPY can return back up to that high right around 447. Can it do that? Or at the very least, we would like it to stay, of course, above the 50-day moving average. So let's keep an eye on that and see what happens. Of course, please keep your stops in. Our next chart is a daily chart of the Investo QQQ, symbol QQQ. Of course, this chart represents the NASDAQ 100, major index in the market with a lot of the big momentum stocks that lead it. Now, when I captured this chart today at the close, the QQQ was trading at $367.73. That's just below. See, we had this August 5th high here. We had that all-time closing high at $369.67. So we're just a couple of dollars below that. Now we had our low yesterday, which was August 19th. After making that high back on August the 5th, the Qs kind of rumbled around here, finally dropped below the 20-day moving average again down on August 19th, which was yesterday, again dropping down to this low at 359.96, but it managed to stay above the 50-day moving average, which is pretty darned important. We needed to stay above that line. So now again, resistance here remains, potential resistance remains at 370. If it wants to move up and make a new high, that's what it's got to climb above. Then, of course, we can come down here to the 50-day moving average for potential support down here at ballpark 360, 359. Then, of course, we go down here to, we have a pivot low here at 352. And, of course, we have the 200-day moving average down at 329. So like the SPY, we have to see in the next week, can it return to these old highs? Or if the news becomes tumultuous again, especially over Afghanistan, then we'll have to see how the market reacts to that. So I, for one, certainly have my stops in place. I have in hard stops with my broker right now, and we want to be wise. Our last chart today is a daily chart of the Spider S&P Insurance ETF, the KIE. Yes, I'm being conservative here, but you can also make money with it. So I kind of want to be in a conservative spot for this coming week, especially with the Delta variant, all the things we have going on. So I looked at the KIE. I like the setup. The KIE has 54 holdings. Top holdings include Chubb, Marsh & McLennan, AON, American Financial Group, Everest, that whole group. Certainly not a lot in the stoplight, but certainly capable of making money in the right conditions. Now, when I captured this chart today, the KIE closed at $39.23. The recent highs were in May back here at about $40.60. And after it did that, the KIE fell in a downtrend here, if I can draw a straight line. As you can see, dropped under the 50 and 20-day moving averages. And actually, it came down to a low here at 3646 on that July 19th, where a lot of assets made a low on July 19th. So the KIE fell down to 3646 on that day, and then you see I connected these lows to make a trend line. From there, it popped back up, back over the 50-day, then returned back in the last week or so to the 20, which just crossed over the 50, which is a good thing. 200-day moving average is below. So we see the 20 just crossed over the 50. Price is now trading over both, but just over both, which I like. And so what I'm going to do here, if in the coming week, again, I'm staying conservative, but you know what? It's not how much you make sometimes, it's how much you don't lose. So actually, that's true a lot of the time. So in the coming week, if the KIE can stay above the 50-day moving average, which is coming in now at $38.46, if it can stay above that, and if the market is in a positive mood, I will add a small position of the KIE to my trading portfolio, and I'm going to use my initial stop down here at 37.50. Yeah, that's pretty tight, but I'm not in the mood to take any more than that. If it does rise above resistance here at 40, if the KIE does that, I will add to my position, and of course by then I'll be trailing my stop. So if the market remains strong next week, you may want to keep an eye on the KIE. And now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, please check out my trader training programs. You will like my simple strategies, and they're targeted to swing trading, trend trading, bottom fishing, and many more. And they can help you increase your gains quickly and easily. To see all of my training programs, simply go to the link on this screen or click on the orange button below. And now on for final thoughts. This week's question is, do I stay in a trade? Do I stay in a losing trade even if my reason for entering is no longer valid, or at least isn't valid at the moment? Well, hey, everybody does it. Many times we will enter a trade because we've heard the company is ripe for a takeover. Oh, somebody's going to buy that. Or the company has issued good earnings. Or the sector was upgraded. Or the setup is a good one, and I love that, but we got to have other reasons. Or maybe an analyst on a financial network said the company was going to be the new Apple. Whatever the reason, the trade seemed plausible at the time you bought in, and it probably was. Many times, though, if the trade reverses on us and heads for a loss, we need to let go of it and realize that the reason we entered the trade no longer matters, at least not at that moment in time. Still, many times we stubbornly hang on to the trade and we're taking denial to the outside of the envelope. Denial is one of the biggest reasons traders lose money. As humans, we want to be right, and we traders can be very, very stubborn about hanging on to the original reason we bought or sold a stock, whether it's losing money or not. No, I bought it because of that reason, and that's it, darn it. So we deny that the stock is weak, at least price-wise, and we hang on to a losing trade, and we lose money. So take the time each day to examine your trades. If the trade is moving against you, review the reason you entered the trade. Is it still valid, or does it align with the time frame that you've assigned to the trade? If you've assigned like a swing trade to a company that said, well, we came out with good earnings, we might do it again, that's fine. But if the price itself is falling, reason or no reason, you're still going to lose that money, and maybe you don't need to. Maybe you'd be best off exiting the trade and taking your present loss and then using that capital to enter a trade that might have a better chance of succeeding. So please don't take denial to the outside of the envelope. We don't want that to make us lose money. Finally, please know that if you'd like to become a consistently winning trader, this is a great time to check out my trader training programs. To see all of my online training programs, simply go to the link on this screen right here or click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.